Hey everyone, welcome back to the channel where we break down the economy that hits your wallet hardest, and today we're diving deep into the US housing market. If you've been sidelined by sky-high mortgage rates and a frustrating shortage of homes, this one's for you. Picture this, it's October 2025, the federal government is in its third week of shutdown, and home sales are grinding to a halt. Buyers in flood-prone spots like Florida and Louisiana can't even get new flood insurance policies, stalling thousands of closings daily. But here's the big question burning in everyone's mind. Will mortgage rates finally dip to around 6% next year, sparking a real recovery in 2026? Or are we stuck in this affordability nightmare a while longer? Stick around as we unpack the data, the roadblocks, and what it all means for you, whether you're a first-time buyer, seller, or just watching your retirement nest egg. Let's start with the cold, hard reality of right now. The US housing market is in a deep freeze, and the government shutdown is pouring gasoline on the fire. Existing home sales, which clocked in at a seasonally adjusted annual rate of 4 million units last year, are on track to dip even lower this fall. Why? Because key federal programs are offline. The National Flood Insurance Program, NFIP for short, has suspended new policy issuances since October 1st. That means any home in a high-risk flood zone, which covers about 20% of the country's properties, can't close without coverage. Analysts at Home Abroad crunched the numbers and estimate this alone could derail 3,600 closings per day, wiping out roughly $1.6 billion in daily sales volume. We're talking billions in lost momentum over just a few weeks. It's not just flood insurance hitting the brakes. Government-backed loans are feeling the pinch too. FHA mortgages, popular with first-timers putting down less than 3.5%, rely on the Department of Housing and Urban Development, HUD, which is operating on skeleton staff. VA loans for veterans? Same story through the Department of Veterans Affairs. And don't get me started on USDA rural loans, those are basically paused, leaving buyers in places like upstate New York or the Midwest high and dry. During the 35-day shutdown back in 2018 to 2019, the National Association of Realtors reported a noticeable drop in existing home sales, with frustration rippling through the industry. Fast forward to today, and a Mortgage Bankers Association survey shows 75% of realtors saying past shutdowns didn't kill deals outright, but 22% saw direct hits to clients, delays in IRS income verifications, slower appraisals, you name it. The Bureau of Labor Statistics even delayed its October jobs report, which the Fed watches closely for rate decisions. Result? More uncertainty, jittery buyers pulling back, and sellers holding off listings because who wants to chase a market this volatile? Zoom out, and the shutdown is just the latest gut punch in a multi-year slump. Inventory is creeping up, active listings hit 4.2 months supply in September, up from rock bottom 1.5 months in 2021, but it's still nowhere near the 6 months needed for a true balanced market. Home prices? The median existing home price sits at $422,600, up 2% year over year per NAR data, but that's cold comfort when affordability is at its worst since the 1980s. A typical family needs to earn $114,000 annually to swing that mortgage at current rates, versus $80,000 just a few years ago. Construction sputtering too, new single-family starts are hovering around $900,000 annually, hamstrung by high material costs and labor shortages. And let's be real, the psychological toll. Buyers are burned out from bidding wars that vanished, only to face this limbo. Sellers? Strategic patience, as one realtor put it, waiting for the chaos to clear. But here's where it gets interesting. This shutdown won't last forever. Congress has retroactively funded NFIP in every prior lapse, and history suggests deals will resume once the lights flick back on. Short-term impacts are minor for conventional loans backed by Fannie Mae and Freddie Mac, which keep chugging along. Past shutdowns proved resilient, sales largely unaffected overall. The real wildcard is how long this drags. If it stretches into November, we could see October data blown out, as economists say, skewing forecasts and spooking investors. Yet, even in this mess, there's a silver lining. Mortgage rates have already eased to 6.3% for a 30-year fixed, the lowest since late 2024, thanks to the Fed's September cut and cooling inflation. That's down from 7% peaks earlier this year, shaving about $200 off monthly payments on a $400,000 loan. Now, let's fast forward to the million-dollar question. Recovery in 2026 with rates around 6%? The forecasts are lining up for cautious optimism. Fannie Mae, in its September Economic and Housing Outlook, projects 30-year rates ending 2025 at 6.4% and dipping to 5.9% by year-end 2026. That's a game changer, boosting refinance activity from 26% of originations this year to 35% next. The Mortgage Bankers Association chimes in with rates averaging 6.5% through much of 2026 but stabilizing lower as inflation hits the Fed's 2% target. Why the drop? Expect 2 more Fed cuts this year, 0.25% each in November and December, pushing the federal funds rate to 3.75 to 4%. Bond yields follow suit, and with GDP growth slowing to 1.8 to 2% amid tariff talks, pressure builds for easier money. Pantheon Macroeconomics even sees rates at 6% flat by late 2026, assuming no recession. What does this mean for sales and prices? Buckle up, experts see a rebound. Fannie Mae forecasts existing home sales jumping from 4 million annualized in 2025 to 4.446 million by end 2026, a solid 11% bump. NAR's chief economist, Lawrence Yun, is even bullisher, 9% growth in 2025 sales, accelerating to 13% in 2026 as pent-up demand unleashes. New home sales? Up 8%, per NAR, fueled by builders offering incentives like rate buydowns. Inventory should hit 4.5 to 5 months supply, giving buyers breathing room without crashing prices. Home values? Expect modest gains, NAR predicts 2% to a $420,000 median, while Fannie Mae sees 3.6% national growth. Regional splits will shine. Sun Belt spots like Austin and Phoenix cool off with more supply, while affordable Midwest markets heat up. No crash on the horizon. Experts like those at the Conference Board peg economic stability at 2 to 2.2% GDP growth and 4.3% unemployment, keeping the floor under prices. But let's talk ripple effects, because housing doesn't exist in a vacuum. Lower rates could supercharge related sectors. Construction jobs, down 5% since 2022 peaks, might add 100,000 roles as builders ramp up. Think more data centers and multifamily units tied to the AI boom. Home improvement retailers like Home Depot? Sales could tick up 3 to 4% as new owners renovate. Even appliances, refrigerators, washers, see a lift. The NABI estimates every 1 million home sales boosts that industry by $5 billion. On the flip side, if rates stick higher due to sticky inflation or election year tariffs, affordability bites harder. Zillow warns 5 million more households could qualify at 6% versus 7%, but we're not there yet. And don't forget lifestyle drivers, the 5 Ds of diplomas, diapers, divorce, downsizing, and death, keep moving people regardless of rates. So, if you're a first-time buyer, here's the playbook. Right now, with the shutdown chaos, hold tight if your deal involves federal backing, talk to your realtor about contingencies. But position yourself, boost your credit to 700 plus, save for 5 to 10% down, and explore down payment assistance programs that aren't shutdown tied, like state housing trusts. In 2026, target spring, March to June, when listings peak and rates should hover sub-6.2%. Shop lenders early, even a 0.25% rate shave saves $50 monthly. For sellers, list strategically now if you're not flood dependent, beat the winter lull. Price realistically, overpricing in this inventory uptick world means sitting longer. Come 2026, more buyers mean faster turns, but expect negotiations, aim for 1 to 2% below ask to close quick. Wrapping this up, folks, the housing market's pause button is hit hard by this shutdown, but 2026 looks like the reset we need. With rates eyeing 5.9 to 6%, sales rebounding 10 to 13%, and inventory easing, relief is on the horizon. For buyers, a shot at entry-level homes. For the economy, a spark in construction and spending. It's not a boom, but after years of lockout, it's progress. What do you think? Ready to jump back in, or playing the long game? Drop your thoughts in the comments, smash that like if this helped, and subscribe for more breakdowns. Hit the bell so you don't miss our next deep dive on Fed cuts. Thanks for watching, see you soon.